Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Joseph Zipfel, investment manager at Startup Funding Club. Hello, Joseph.
Hi, Alex. Thank you for having me.
First off, can you tell me what is Startup Funding Club?
Sure. So Startup Funding Club originally was founded as an angel club. So a group of individuals who were all successful entrepreneurs looking to invest in the next generation of founders. That original club of about 20 individuals has now grown to more than 500 members. So it's become one of the most active angel networks in the UK, if not the most active angel networks. We won Angel Syndicate of the Year twice, 2016, 2017. And alongside the angel network, we've been operating since 2013-14 an SEIS fund, which became an SES and ES fund. The idea being that we co-invest from the fund alongside the angel network. So in a nutshell, that's the model. So what we offer to fund investors is the opportunity to co-invest with very smart money alongside experienced angel investors who typically get quite involved with the companies, have particular expertise that they bring to the businesses, and that we obviously tap into as a fund.
And what's your own experience?
So personally, so I've been with Startup Funding Club for 5 years. Previously, I was in investment banking, so I come from a finance background. Within the team, we've got actually quite a diverse set of skills and experience. So Stephen Page, the founder, he's someone who's built and grown and exited software companies throughout his life. And we've got members of the team who worked at British unicorns and who had entrepreneurial experience. So we've got a varied sort of set of skills and experience that we bring to our investment decisions, which is quite helpful.
So let's talk about the SEIS specifically. Sure. What does it aim to do for investors? How many companies would you typically be invested in?
Right.
You know, target returns?
Sure, yeah. So we're known in the industry for being very active. So our strategy is to build sort of diverse, relatively large portfolios of companies for investors. So if you invest in our fund, you can expect to have at least a dozen companies in your portfolio. So we do about 20 to 30 investments every year across 2 tranches. We are sector agnostic, so that's a big differentiator of our fund. We don't restrict ourselves to any sector. We don't restrict ourselves to technology, even though that's 60 to 70% of what we do. We love consumer products. We love industrial goods. Some of our biggest successes to date are companies in those sectors. So if you invest in our fund, you will have quite a diversified portfolio of company, both in terms of portfolio size, but as well as sector diversification, which is very, very important at the SES end of the market, which is obviously quite high risk. So you want to spread your risk towards across a large portfolio of companies.
And how many companies would I normally get access to?
So typically a dozen. Okay. That's the sort of expectation. It's subject to fundraising, so it could be larger than that. Our investors tell us that larger portfolios bring an attractive risk profile. So we aim, if we bring the portfolio to about 15 up to 20 companies, that's a scenario that's possible.
Can you give me some examples of companies you've invested in?
Sure. So last year we've done more than 20 investments. So there's quite a few to pick from. One company that we're very excited about is a company called Cognizant. It's a very good story because we originally invested back in 2016 as part of the first SES round, and followed on last year on the ES. That's a software company, lead generation software, SaaS product that's doing extremely well. It's one of the fastest growing SaaS companies in the UK at the moment. And they've just closed a big funding round led by Oliver Wyman, the financial services consultancy, so, which brings enterprise clients on the table and potential route to exit. So a fantastic kind of scenario. But as I say, we don't do just software and tech. We've got another company that's a great success story in the making at the moment, a company called Transcend Packaging. So they are a sustainable packaging company, so they produce a wide range of products for high street food chains. So think of all your fast food chains, from coffee shops to fried chicken. They won a huge account last year. McDonalds became one of the clients to supply nationally paper straws to their restaurants. That's just obviously made a lot of press and noise in the market. So The company was only incorporated in 2017. We invested in March as part of the SEIS round at a company valuation of less than 800K. The company is now valued at over 10 million pre-money, and that's happened within a year. So that's what I meant earlier by we don't restrict ourselves to technology. We think there's fantastic opportunities out there in other sectors that a lot of investors, a lot of funds are not looking at. So we try and take advantage of those.
So how do you find these companies, especially the SEIS? It's so small, £150,000 or...
Right.
It can be burnt through in moments.
Yes, the first thing I would answer to that is that you can raise, as a company, you can raise SES and ES pretty much at the same time.
Right. Yeah.
So the typical round size that we work on is about 300K,
right,
which typically is going to give the company at an early stage about 12 months on runway. So the round it has to be sufficient enough that the company can deliver its milestones. So where it comes, the Angel network is quite a huge asset in that respect, because when we put a round together, it's not just the SES bit, it's also having an ES component to the round, and that's where the Angel network and our fund co-investors come in. In terms of where we get our deal flow from, so luckily we've been sticking to what we know for a few years now, so we're quite well known in the market. So we get about 2,000 applications on our website every year. So there's a huge number of opportunities that come to us. We've got guys in the team that just do that, filter through the huge flow of companies coming to us.
So what would make you think, oh, that's a good one to look at it further?
Unfortunately, it's very difficult to judge a company based on the business plan. So what we do is we meet as much as these companies as possible, because we make decisions at the end of the day based on the founders, based on the management team. We look for great talent. I mean, if there's one thing we've learned from doing over 100 investments to date, is that you can't have an A product with a B team. You need an A product and an A team. And solo founders, for example, no matter how great they are, it's going to be tough for them. So we are looking for complementary skill sets and experience within the team. And that's quite difficult to judge on a pitch deck or a business plan. So we get about 20 companies to come every week to the office, and that we take the time to meet all of them.
How am I going to get my money back? When? What's the sort of typical exit likely to be?
So that's the big question, of course. So we, as an SES investor, you have to expect that the large successes will take 7 to 8 years to materialize, to realize. So those companies I mentioned, Cognizant, Transcend Packaging, they are on paper doing extremely well. So the theoretical value of our investment is a multiple of the original cost. But they haven't exited yet. We haven't delivered cash returns to investors. So that being said, we've had a couple of early exits. So we've had 2 exits last year, which were sort of smaller exits. So companies that return up to 2 times the original capital invested. But good to see that.
And what sort of period was that over?
So it was less than 2 years after the original investment. So that's not the typical risk profile or investment profile of an SES investment, obviously. But it's good to show that there's a market of acquirers out there, and it's possible to invest in an SES stage and get a return.
Clearly, the investors have already lost the tax relief, I assume.
So in one case, yes, and the other is actually going to a 3-year period. So we delayed the transaction. So again, it's not our investment model. It's not a strategy. We don't invest in a company to get a 2-year return. As you said, it's a 3-year holding period. But it was a good scenario in the sense that it showed that achieving an exit is possible.
And what sort of return would you be hoping for on a portfolio overall?
Right. So the disclosed target is 3 times your money back. That's our kind of minimum target. Internally we're hoping to achieve much higher returns. We only invest in a company if we can believe that, if they can convince us that there's a credible scenario to return 10 times the original investment. So the company has to show that there's a plan to achieve that. There's a route to that kind of exit. As a team as well, we're extremely incentivized to deliver larger returns. There's no upfront fees on this fund. There's no annual management fees. For us, it's all about the performance of the fund, right? So we are internally looking at higher returns, but the stated target is 3 times your money back, which we think is highly achievable.
So it's very risky, without
Yes.
doubt. What do you do to minimise the risks?
Yes, of course. Yeah. So SES investing is very risky. You're typically investing in the first round of finance of these companies. So it's very, very early stage. The way we go about minimizing the risk is by creating portfolios, as I said, of a certain size. So spreading the risk across a dozen of companies, so you maximize your chance of picking the winners. And as well as diversifying the sector area that you have in your portfolio. So having not just not any overexposure to any sector in particular or to tech in particular, but looking at opportunities that have different market dynamics.
A problem often cited with investing at such an early stage is that by the time the company comes to exit, it's had an awful lot of money put into it, an awful lot of more investors, and you're so diluted, your returns aren't quite as good as they should be.
Yeah, that's
so
that's
what
a
do
very
you do
good
to
point.
avoid that for your investors?
Yeah, that's a very good question. So, it comes back to having done this for a few years and having gone through that sometimes painful experience. So we know that scenario is possible. We are the first investors, and therefore, if the company does well, we will get heavily diluted by future rounds of funding. So we have to take that into account when we talk to the founders and set the terms of the deal. So if the starting point, if your starting valuation in particular is right, you can still take quite a lot of dilution, 50, 60, 70% dilution, but still look at a 10, 20 times return. But you have to there's a bit of education going on with the founders and the entrepreneurs for them to understand that that's the risk you take as the first investor in the company.
An experience so far of company failures? What are you seeing so far?
So we've got currently about 10% of our portfolio that has failed, that is liquidated or has been liquidated. As I said earlier, looking back in hindsight, it's usually a team issue. There was a particular skill set that was not present in the team. Rather than anything wrong specifically about the product or the idea or the business model, but more the fact, for example, you lacked some commercial expertise in the team, and you had too much of a product-centric management team. So you learn a lot actually from these failures, and you learn a lot in terms of what kind of people, what kind of team can actually deliver a business plan, which is extremely difficult.
How involved are you in the businesses? So if it starts going wrong, are you involved or?
Absolutely. I mean, you have to be at the SEIS stage. As I said, we're typically the first investors in these companies alongside the angels. So we get a board seat in every company that we invest in. And we help them put together the governance structure, the reporting structure, the financial controls. So we try and put them in good shape for them to grow the business and reduce the risk of failure. Companies running out of cash is probably the number one reason of failure. So we spend a lot of time with entrepreneurs, particularly in the first year, the first 12 months after we invested, to put in place those controls.
So I want to invest in an SEIS this tax year. Why should I invest it with you?
Well, that's good to hear, Alex, that you're looking at SEIS, because one of my greatest frustrations that SEIS is still, there's a lack of awareness around SEIS, which is a fantastic scheme. I think you would look at our fund and probably think that I will get my SES tax benefits with a managed risk profile, which is quite difficult to achieve. And it comes back to, as I said, the portfolio size, the sector diversification. You'll be also investing in a team that has been doing this for years. We were one of the first SES funds in the market back in 2013. Bearing in mind that SES was only introduced in 2012. So we've got a track record. We've learned a lot in terms of what kind of businesses, what kind of teams we should be backing. And as I said, the track record, the portfolio size, the diversification, our place in a position in the market. That means that we get some of the best startups coming to us every year. We're something I haven't mentioned. We're a partner of the London Co-Investment Fund, so we're one of 12 partners of a 25 million fund funded by the Mayor of London. And that means that any London-based companies raising their first round of finance will probably come to us at the moment, which is a huge asset.
Okay, and of course, if you get it right, investors can see very big returns.
Absolutely, absolutely. So the great thing with SEIS investing is that, as I mentioned, the average valuation that we're still investing at is around $1 million company valuation. If things go well, that value accelerates very, very quickly. So you're potentially sitting on 10, 20 times paper returns. So obviously, as I said, those returns take a while to materialize. But being the first investors means that your potential return the potential upside is quite big. Think of early investors in Uber, Dropbox, that kind of companies, or the kind of returns they're sitting on.
Joseph Zipfel, Startup Funding Club, thank you very much.
Thank you very much, Alex.